Everyone, and welcome to the session on market risk and counterparty credit risk. The one connected story, new live market risk batch called MRM Super 50. So, a little bit about that program. The focus of this program is that it will be hands on practitioner grade training program. So today we are meeting to discuss. I'll give you a one end-to-end demo of all the important calculations that you need to be aware of as part of being a market risk professional. So I'll give you a demo. So that is the highlight of today's session, and I'll show you um, the way the calculations are done in the Excel are closely aligned with how it's done in Bloomberg. All right. So that's the highlight of today's session. And the training program overall, it is, as I said, it's practical hands-on training, and we are not doing pure academics, right? We are doing job-oriented calculations, which are important for how it's done in real life. All right. The course focused on 360-degree market risk, the entire landscape, right? So starting from the front office deal structuring to pricing to sensitivities to risk modeling to risk capital, then stress testing and risk limits monitoring and hedging, right? The whole journey, entire end-to-end journey, you will get in this course. One connected story basically means that we will stick with the same diversified portfolio from the beginning to the end. Okay, every single function that we'll talk about and calculations that we'll see is connected to that same portfolio, right? So there is no disconnect in the concepts that you'll see from end to end. This time you'll get PDF notes, preparation material, Excel files, and Python files as well for each and every topic. So this is to help you review everything and prepare for interviews. Another important highlight of this program is that every Sunday we'll have a live session where we'll focus on problem solving, interview preparation questions. Okay, so this is the highlight of this particular batch. So there will be offline recorded theory lectures that you can watch at your own pace. Come prepared, and on Sunday we'll do a rigorous question solving and interview prep question answer discussion, so that you get best of both worlds, right? Prepare yourself based on the theory and practice questions, and then we'll do a live interaction of what kind of interview questions are important and how do you go about it. And today's world is incomplete without AI, right? If you're not doing this, if you don't know anything about machine learning and AI, agentic AI today, then you are way behind, right? So AI is changing the landscape of every single function that we know of today. Market risk is not different. So we will learn how to use machine learning to do improved volatility forecasting that is important for value at risk and other risk calculations. Also, we'll learn how to build a agent, especially in the model validation space, where the agent would be able to go through your P&L reports and your code and look at the value at risk breach, right? And then come up with an explanation why the breach happened and create a full blown model validation report. So that is what is happening today, right? Model validation roles are being replaced by agents, and you need to know all these things, right? So going forward, I think if you look at quant professional as a skill set, it's the your own domain expertise plus your ability to use AI agents to be better and more productive, both individually and at a corporate level, right? So we need to have that AI literacy as well. So we'll cover all of these in this particular program. So that these are the things that are unique to this particular batch. Right. So as I said, we'll be live in the first week of June if you enroll. Okay. So that's about this particular program in a nutshell. let's proceed. Agenda. I just wanted to give you this particular picture. I know there are a lot of moving parts to this, but keep this in mind, okay? And this will help you be structured in terms of what happens at what stage and why does that happen. All right. Again, this is a very simplified abstract of the entire market risk ecosystem. But let me quickly walk you through this and then I'll show you in Excel an important set of calculations. Taking one instrument as an example, I'll show you end to end how we calculate everything. And as I mentioned, it is very, very different from what we do in academics. Okay. In academics, everything is very, very simplified. Once you step into the real world, you will see, okay, there are so many different considerations we didn't read about, we didn't know of. All right. So that is what it is all about. Okay. All right. Yeah. Existing market students will get this course as is. But going forward, any new student joins will be part of this program. All right. At a high level, so understand that in the heart of all of this, right, we have instrument. There are financial instruments. Now, there are two types of financial instruments. Instruments which are liquid, okay, that are traded in the market. And there are some other instruments, exotics, which are not that liquid. Okay, there are two types of instruments. Every instrument has a price function. Price function means a valuation engine or a pricing engine. Okay, every instrument has a price function. That function takes risk factors as input and gives the price as the output. Okay, that is a valuation formula for every instrument. Risk factors. What are risk factors? Risk factors are interest rate curves or FX spot, FX curve, volatility curves, volatility surfaces, volatility cubes. Right. We have a lot of different types of risk factors under different asset class. So we have a price function that using that you can calculate the price of the instrument. Now let's go here. So the price function gives you the model price, what it should be based on the formula or the function. If the instrument is traded in the market, then it also has a market price. And that is governed by demand and supply. Now, what we typically do is with the price function, you can price any instrument, but you need to have a starting point, right? That starting point is basically you look at liquid instruments that are traded in the market, and then you assume these market prices are correct. Market prices for the liquid instruments are correct because there are so many players, so they cannot be wrong, right? So what we do is there is a back channel. So start with the market price of the liquid instruments, put it in the model price, and figure out the parameters of your model pricing. We use a lot of different parameters in the model. For example, Black-Scholes has so many parameters. Sigma, for example, right, is something that is not known, and we typically calibrate sigma from liquid options, right? Similarly, for interest rate instruments, this calibration would mean creating the spot rate curve or term structure from liquid interest rate instruments. For example, deposits, interest rate swaps, futures, okay, which are heavily traded in the market. We look at those prices, fit a model, back out the interest rates, discount factors, things like that. Okay, so that is calibration. It's the opposite way. And pricing goes this way. From the risk factors, pricing function, model price. Match market price with model price, calibrate, figure out the pricing function and other parameters. Okay. The other angle is, so this is risk factor leads to price. Change in risk factor leads to change in price. Change in risk factor leads to change in price. That is through Greeks or sensitivities. Okay, every instrument is sensitive to a bunch of risk factors. If those risk factors change, and they change, right? These factors are not constant. Then what is the change in the instrument? The one that connects the delta of risk factors to the delta of price of the instrument. That is actually called as a local valuation, and it is done through Greeks. This is where you will learn about different types of sensitivities and the Taylor series expansion that is helpful to connect the change in risk factor to the change in price. Change in price also is called as the PNL, right? So how do you get the PNL? So two things you have to know about. This is the area where you have to have a lot of expertise. How do I go from here to here? Now, when it comes to risk modeling, typically risk department has a considers a subset of all the front office risk factors, right? So for option pricing, I know it's going to be too. I don't want to get into too much into the weeds at this moment because there is a lot. So I'll try to explain at a high level. If you're trying to price an interest rate option, you have to look at volatility cube. Okay, so cube basically means it's a three-dimensional entity. There is a moneyness dimension or strike dimension. There is a tenor dimension. There is an expiry dimension, and then you have volatility for each. But from a modeling perspective, we typically go with reduced set of risk factors because in market risk, what we are trying to do is that not find the price of the instrument right now. That is the function of front office. They are doing it. For market risk, what we need to do is if the risk factors change, what is the impact on the instrument? And we are looking at a worst case scenario. Okay, what is the worst case move that is possible for the risk factors? And if that happens, what is the loss on my portfolio? That is what is the focus of market risk. We are trying to model a worst case loss scenario, right? So to do that, you need to have access to the entire time series of the risk factors, how they have moved in the history. That becomes your starting point. And then you impose some kind of distribution, or you look at the different, just look at the time series as is, right? In history, it has moved like this. So in future also, it will move like this. If it moves like this, what is the worst case scenario, right? So you need to have data, lot of data points for those risk factors for them to be modelable. Otherwise, how would you predict the worst case move? You need to have sufficient data points of that risk factor, right? That is why we start with a subset of risk factors which are where you have plenty of data points so that you can fit a distribution, you can do time series forecasting. To do any of that, you need data points. Not all, you don't have access to the time series data for all the risk factors that front office uses for pricing. So it's always a subset for risk department. So here the different types of considerations like modelability, liquid prices, stale prices, proxy, all these things come into picture. Okay. So two things we're trying to measure here, that in case of a worst case move of the risk factor, what is the loss on the instrument? Okay, and there are different risk measures like value at risk or expected shortfall, and there are plenty of different approaches in which we can do that, right? Historical, parametric, Monte Carlo, things like that. And there are other types of curated scenarios which are not specific to the current regime as such, but these are hypothetical and other types of scenarios where we break the norm and just postulate that if this kind of a stress scenario happens, for example, US-Iran war or Russia-Ukraine war or another COVID type of situation, oil crisis, any kind of stress scenario, then what is the stress loss on the portfolio, right? Okay, so one more thing. Here I'm talking about one instrument. Ultimately, we'll have a portfolio. A portfolio is a collection of instruments. So you can imagine how many different types of instruments would be there, right? We have interest rate swaps, futures, forwards, options, all kinds of exotics under different asset classes, equity, FX, interest rate, commodity, right? So this is the story of one instrument. Ultimately, you have to do it at a portfolio level. So the concept of risk aggregation comes to picture, right? Instrument level story is one story, but then when there are a lot of instruments, how do I aggregate the risk and calculate these at a portfolio level, right? So that's risk management. And once we have a handle on the sensitivities and the type of losses that we are looking at, here is the dashboard. So we have to basically this shows you the portfolio exposure um, under different important sensitivities that are important for the risk manager or even CRO. Okay, they have dashboards where it will aggregate all the important sensitivities at a portfolio level, right? What is the overall delta sensitivity for a equity risk factor? For example, S&P 500, right? Overall delta with respect to that. DV01, right? US dollar exposure, or any other exposure. So different sensitivities get aggregated and reported at the portfolio level. And finally, based on this, if some of these sensitivities or risk is breaching a limit, because as part of risk appetite framework, board members will specify limits. This much equity delta we can take, this much interest rate vega we can take, right? So when this is fluctuating, they we have to keep an eye on the limits, and if they are breaching the limit, then you have to come up with a hedge portfolio or redesign your hedge portfolio so that the exposures stay under the limit. Okay, that's the overall idea. And at a very high level, these are the things you need to remember. Any questions on this? I hope this picture is clear, guys. All right, if no questions, then let's proceed with an actual end-to-end demo. So question, can we make our own portfolio? Of course. So in this batch, we will go after each and every type of instrument. Okay, we'll learn about forwards, futures, swaps, options, and some exotics. Not all exotics, some exotics. And you should be able to do all of these for every instrument and also as a portfolio. And when I talked about connected story, right? We will stick with the same portfolio from beginning to the end, so that you know exactly how is the handoff between different calculations, and the story will be one connected story. It will not be a disconnect between concepts. Okay. All right. So if you at high level, if you understood this, let me take you through a real life example of one of the instruments. Okay. And the instrument is interest rate swap. Interest rate swap. Okay, before I go there, there is a question how to model geopolitical risk. We will discuss that. I already, I think, have shared a post on LinkedIn how to model geopolitical risk. It'll be part of the stress scenario design. Okay, so we have different approaches. There is a geopolitical index that is being published, which we take and our anchor our scenarios are based on the geopolitical risk index. And when it moves, what is the impact on market risk factors such as FX, equity, IR? So geopolitical index, if that moves, how does that influence the market variables? Because those market risk factors are linked to our loss distribution. So that is done through so the one important famous approach that was I think put forth by the inventors of geopolitical index is impulse response function. Okay, so we will discuss all that when we model when we talk about stress scenarios. Yes, it is covered in the course. Okay. All right. Now, let me take you through an actual end-to-end example for just for interest rate swap. Interest rate swap is such a beautiful instrument in the sense that it is also very important because lot of the things that you see in interest rate world come to life in the swap. There is a fixed bond component, there is a floating bond component, and there is discounting, pricing, sensitivities, everything you can do for interest rate swap. It's a linear product, but it has a good mix of fixed rate, floating rate. So if you master interest rate swap, it'll be a big, huge win actually, right? If you think of FRA, FRA is just a one period swap. It is a subset of interest rate swap. So if you master interest rate swap right in the entirety, then you have really achieved a lot. And interest rate swap is the most predominant instrument used for hedging purpose. If you look at Indian banks, primarily in your interest rate book, it will be interest rate swaps, mostly interest rate swaps. All right. So let's take that as an example. Then I'll show you Bloomberg style calculation, okay, from beginning to end, and how all of these functions are tied to each other. Okay. So, and this will also give you a flavor of how we are going to cover the uh, topics in this particular course. Okay. So, start off, we will start with interest rate swap pricing. Okay. Now, remember, if we go back just a little bit, heart of the entire ecosystem is the instruments, right? First, you need to learn how to price an instrument. Closely associated with the price, we have Greeks or sensitivities. This is the first thing that you need to learn because it is at the heart of the entire picture, right? Without this, it will be difficult. So, we are starting with this. Now, what you're looking at is an exact replica of Bloomberg screen for interest rate swap um, pricing template. So what happens is front office, you have these pricing templates available where we can quickly and conveniently structure a deal with a client. This template is for interest rate swap that is used in Bloomberg. So you can most of the things you can see and you probably are familiar with. Some of the things will be new. For example, let me quickly walk you through this. We have two legs, right? Receive leg and a pay leg. You can have receive fixed and pay floating. So here you specify the maturity, start date, end date, payment frequency. Day count convention is one of the most important attributes which often gets ignored in textbooks. In textbooks, what happens is when you are given, to price an interest rate swap, typically you will be given a term structure, and the term structure will have equal frequencies like quarterly or semi-annually, annually, and your cash flows fall exactly on those tenors, and pricing is easy peasy, right? That is not the case in real life. In real life, it is highly possible that you will miss some number of days. Day count convention, holiday convention, spot lag, roll convention, payment lag, all these things matter. Otherwise, you'll never get your pricing right. And important thing, please pay attention. When you land a job in this space, right now we're talking about pricing, right? There is a function called independent price verification, IPV. A lot of jobs are there in that space. Okay. Some of you are already working in that space. If you appear for an interview, they will first ask you, do you know how to price an IRS? What are the things you will check or validate? Okay, so in as part of model validation, or in this case, independent price verification, you should be able to match the price of the IRS with the vendor platform. Suppose you are using Nurex or let's say Bloomberg uh, or any other software. If you are doing independent price verification, by hand manually, you should be able to match the price. Okay, so that is what we learned here. So here I've tried to reconcile the Bloomberg's calculation. I'll show you the steps at a high level. There are some more steps also. We will do it in detail in the course. But this is just to give you a feeling of what are the things that are involved and what you should know and what happens in real life and how that is different from academic exercise. Right? So you can see so many different parameters here. So we have, I mean, my intention is not to go through the maths right now. It's just a high level. What are the components, calculations, and the order of calculations that you need to do? And some important considerations that you have never thought of, right? So this is the dashboard that shows the present value of both the legs. and some sensitivities and DV01 and other stuff. As I said, this is the exact replica of Bloomberg, and we will be able to match Bloomberg calculations. So you should be confident going forward, because our calculations are now validated against the benchmark, right? Bloomberg is the benchmark. Increase the size. Let me see. Give me a moment. Okay, I hope this is better now. All right. So this is the pricer, okay? So you can construct, change the maturity, change the notional, change the frequency, change coupon rate, change anything you want. That will show the new price, and this is how you structure the deal with the client, right? Okay, so that's it. Now, question is, in order to get the present value, so here I'm going to ask you some questions. Please interact. Let me see. It will be good for you to see that if you're able to answer, right? So check your understanding. To get the present value, what other parameters I need? What do I need to calculate the present value? Discount rate, future cash flows. Excellent. So first you mentioned discount rate, right? For discount rate, I need a risk curve, the interest rate curve, or you can say zero rate curve. Now there are so many different types of curves, right? There is yield curve, but yield curve, when you just say yield curve, is it a zero coupon yield curve or a coupon bond yield curve, right? Second, par rate curve, swap rate curve, and then we have the zero rate, forward rate, right? Zero rate is also same as spot rate basically. And then we have different types of compounding convention, continuous, simple, all these things. So you can define your zero rate. Zero rate curve is a zero coupon yield curve, or called as spot curve, which is a fundamental entity for pricing, because you'll be discounting cash flows using the zero rate curve. So we need a zero rate curve, and this is the term structure. So different, you can see weeks, months, year. Again, this is exact replica of Bloomberg. So here is the zero rate curve, okay, and the corresponding discounting factor. Great, but it's not that simple. Just to if you want to match the first discounting factor, use this zero rate, use 1 week as the term, calculate this discounting factor. It will not match. Okay, if you it will not match if you are not careful. To price an IRS, which is a linear instrument, there is no option, there is no vega, there is no um, non-linearity, right? It's a linear product. All you need to do is match the discount factors, right? And the correct days when these cash flows would happen. Okay, that's pretty much that is required to price it accurately. If you want to calculate discount factors here, is 1 week 5 days or 7 days or more than that? All these things need to be captured. So we have to use the entire holiday calendar, because when you calculate the number of days, right, holidays become very, very important. So this is the US holiday calendar all the way till 2035, right? Public holidays, and EU holiday calendar. Without this, you will never be able to match. Okay. So basically what happens is these are the calculations you have to do. What is the curve date? So standing right now, the date is, I think I had it here. Yeah, 5/15/2026. That's the curve date when you are seeing this curve. The valuation does not start immediately. It starts after a spot lag. Okay, there is two business days typically. That's the setting. So it's current plus 2 days. That is when the valuation would start. Okay, and then you adjust you figure out the first this particular date, which is after a week. But if this falls on a holiday, then there is another adjustment, holiday convention. Okay, so the typical setting is modified following. That means if it's a holiday, then go to the next one, next day, next business day. If the next business day falls in another month, then you come back to the previous month. So yeah, don't worry about these details, but there is a quite a bit of consideration in just to make sure that your the way you are counting the days is accurate. So there are actually 11 days in this first term. It is not, if you go by 5 days or 7 days, it will never match. There are actually 11 days. And this discounting applies for 11 days. Days is your final unit of currency. Okay. Ultimately, you can convert that into year fraction based on your day count convention, Act by 365. Okay. So these are the discount factors that I got from, by calculating by hand, and I am reconciling with the Bloomberg's discount factor. They are perfect match. There is a little bit of difference here, but typically business, when we are doing model validation or pricing verification, there is always a delta or threshold that you can tolerate, that this much deviation is fine, right? So we're going to talk all about those verification steps. But you can see, so my objective for today is to show you how involved these calculations are in real life. It's not a matter of just, taking the discount factor to the against the term structure and just ignoring the day count convention, all these lags and holidays and calculating cash flow. Don't do that anymore. Okay. So this time we're doing everything right, and exactly how it happens in real life, so that when you step into the job, nothing will surprise you. You have already done all these things. That's my intention. All right. So this is the deal pricing template. This is the risk factor data. We just need one risk factor because it is interest rate swap in one currency. If it is a cross currency swap, then there will be multiple risk factors. Okay, domestic and international, and sometimes you also have to take the basis curve. Okay, so we'll talk all about that. I'm just showing you everything just for a simple plain vanilla fixed floating interest rate swap. Once you are good with the rate curve, you need to calculate cash flow table. So cash flow basically means how much you will get, receive, how much you will pay, on which date. Pay date has to be accurately calculated. Okay. So, okay, the calculations are also again very involved. So based on that quarterly frequency, right, there will be 20 payments. In 5 years, 20 payments. That's fine. Two things you have to consider: accrual start and accrual end. Because for every period, right, you will do a coupon payment, fixed coupon payment, floating coupon payment. But the amount will depend on the length of the period. Now, in academics, what we used to do is when we studied interest rate swap for the first time, we blindly assume everything is 0.25. Quarterly means 0.25 is the year fraction. That is not accurate. As you saw, because of holidays and all these things, right, it can be different. So see, number of days is sometimes 92, sometimes 94, 87, 90. These are important. So accrual start, accrual end, that defines your coupon payment amount. And it also determines your floating period. Yeah, floating rate and fixed rate and the coupon amount. Okay. So that is the calculation. The other important calculation is present value. You got the coupon payment. These are the payments. Now I need to discount them. What discounting factor should I use? Is it based on accrual start or accrual end or something else? It is based on pay date. Pay date can be, let's say, 1 or 2 days after the accrual ends. Okay, depending on the payment lag. Right now, the payment lag is 0, but you can have, let's say, your accrual period ended today, payment happens after 2 days. It's the same amount, but that will be paid after 2 days, not immediately. If that happens, you have to use the right discounting factor. Discount factor depends on when that cash flow is happening. Correct? It is not when the accrual period ended. So you'll miss 1 or 2 days if you're not careful and your calculations don't match. Okay, so you have to be very, very, meticulous in terms of calculating all your days. There is no room for error. Okay, so only when you do it accurately, then your pricing would match. So remember just two things, right? Accrual start, accrual end, we have to calculate for every period. Don't take it blindly as 0.25 or zero point 0.5. And for the present value calculation, you need to look at the pay date, okay, which may be a lagged date. So take all of these into consideration and calculate the cash flow. And here I have also matched the cash flows from Bloomberg. Okay, this is the error, which is 0%. So that's cash flow. All right. So again, recap. Deal pricer uses zero rate curve as the risk factor. And from that curve, we can calculate cash flows. Now, typically what used to be before SOFR came into picture is we used to have two different curves. One for discounting and one for cash flow projection for the floating payments. Two different curves. You can still have it today. But typically people have moved to one single risk factor per currency, right? There's the RFR that has, after the RFR has come up, we are moving back to single currency regime. Okay. What's next? You got the value, you got the cash flow, we got the cash flows, we got the value by discounting them. Next step is to calculate risk. So we have KR01, which is a key rate sensitivity. This is that calculation. So what we want to do is calculate sensitivities. If tomorrow the 2-week rate shifts by 1 basis point, what is the PNL on the IRS interest rate swap? Okay, if the 6-month rate moves by 1 basis point, what is the change in value of the IRS? So for every tenor, how Bloomberg does it is it does a upward shift and a downward shift and calculates the PNL numerically. Okay, it's not an analytical method. We can still use analytical method, but bumping and repricing is the most accurate. Okay, yeah. So you can see against every tenor, I came up with what will be the change in value of a particular leg, receive leg, pay leg, in up scenario, in down scenario. Then you combine up and down to come up with one single PNL. Okay, this is how much the receive leg will change in present value terms if there is a 1 basis point shock in these tenors individually. This is called KR01 matrix. Similarly for pay leg, and then you have to net them because you have a long short position, right? Interest rate swap. So this is a net KR01. And you can also add everything and you call it as DV01, which is if all the entire term structure moves by 1 basis point, that means parallel shift, then how much will be the impact on PNL? That's DV01. So receive leg, pay leg, net, and also second order you can calculate gamma, which is the nonlinear part of it. Although from a risk calculation, regulatory risk calculation perspective, for linear products, we do not require this. This is required for options. But it's okay because, there is some convexity associated with simple bond type of, instrument, which is essentially what IRS is all about, right? It's a long short position in fixed bond versus floating bond. So gamma is there. Okay. So we got the risk sensitivities against our tenors. That is the main calculation here. What do we do next? Next, remember when I said that we have our internal set of risk factors. So these are our internal set of risk factors. Regulation has their own set of risk factors. So if you look at FRTB capital, which is the latest market risk capital standard, there are only 10 different tenors, which are regulatory tenors. 3 months, 6 months, 1 year. Here we had 1 week, 2 week, 3 week, 1 month, 2 month. You see, when I talked about reduced set of risk factors, this is exactly what it means. These are the most liquid tenors, and you are monitoring the time series of the rates against these tenors, and these are modelable. because you have enough data points, right? Uh, so this is the risk factor, a set of risk factors as per FRTB. So what we need to do is tra- pay attention. This is important. Transfer these sensitivities from these risk factors to these risk factors. Now, these are my sensitivities to these risk factors. How did I do that? How did I transfer the sensitivities from these set of risk factors to a reduced set of risk factors? Right? Uh, does anybody know how we do that? This is a very important step because in risk modeling, most of the times you'll have a reduced set of risk factors which are liquid and modelable. Okay, one answer is reducing risk factors using PCA. That PCA will help you, yes, figure out which risk factors are the most predominant, right? And then, yes, there is a little bit of linear algebra there to transfer the sensitivity. Yes, that is one way. But the term that I was looking for, yes, interpolation is also the right answer. We need to split the sensitivities and I'll assign on these vertices, right? Using linear interpolation. That is one way. The formal method of doing that is something called as Jacobian. If you haven't heard about it, it's fine. You can go ahead and Google after the session. We use Jacobian. Jacobian is a matrix. You just multiply the our core internal sensitivities with this matrix, and you'll get the regulatory sensitivities. Right? So just to give you one simple example, the 3 month this 3 month sensitivity which we have here, right? It's not exactly 0.25. Our 3 month is 0.26301, right? Taking into account all the day conventions and all these things. This tenor, and this is the sensitivity that we have, will be divided to, some part of this will go to 0.25, which is this, and this is very close to 0.25. So majority of this part went here, and little bit will go to the next tenor, which is 0.5. See, little bit, because 0.2630 is between 0.25 and 0.5, right? So part of that sensitivity goes here and other part goes here. And that breakup is given by this percentage. 94.79% goes to the 0.25 tenor and 5.21% goes to this tenor. And this split or the breakup is derived through linear interpolation, right? So we'll talk all about that. But at the end of the day, you have a matrix to do these calculations conveniently. So we transfer sensitivities from our internal tenors to the regulatory tenors. So that's an important step. And we got this final set of sensitivities to the risk factors. So this is one side of the story. Okay. Chapter 1. Chapter 1 involved pricing, calculating the sensitivities, transferring those sensitivities from internal set of risk factors to the regulatory risk factor set. All right. And this is very, very involved, as you can see, just for one single instrument, interest rate swap. But similarly, once you master one product, right, end to end, we can talk about other things, other instruments. You just have to familiarize how the pricing is done, how the sensitivities are calculated, and then the rest of the story remains the same. Okay, after this, you don't worry about the instrument anymore. My instrument is now, I can look at it as just this. It's just sensitivities to these risk factors. Okay, that's the story. So exactly how, when you eat some food or drink some beverage, for your body, it doesn't matter what kind of food you are eating. For your body, what matters is how much sugar you're eating, what is the cholesterol level, what is the calorie level, sodium, and other ingredients. These are the ingredients, right, against those dimensions: sugar, calorie, potassium, I don't know, whatever ingredient is required. So this is just a package. right? Sensitivities against those risk factors. That's what the instrument is all about. Once this is done, you can forget about this. The next step, what is the next step? The next step is we assumed the zero rate curve is given. But how do you get that zero rate curve? Where do you create the what is the starting point to build this kind of a term structure? Because this is essential. Zero rate curve will define my discounting curve, it will define my projection curve, and I'll value IRS. So the next step is, once you master pricing, we need to be able to extract the zero rate curve from the market rate. So see, on the left hand side we have market rate. Market rate is not same as zero rate. Market rates are the quotes of instruments, how they are traded in the market. Okay, for example, you'll have, for futures there will be a future price and an associated rate. Okay, for swaps it is typically the swap rate. For bonds we have par rates, right? For swaps we have swap rates. And in the market you directly see the swap rate. Swap rate changes frequently in the dashboard. From there, immediately, you should be able to derive the zero rate curve, because this is what we need for valuation and risk modeling. But instrument, we do not have zero coupon securities for these maturities. Okay, these are synthetic instruments. We do not have zero coupon bonds traded in the market for all these maturities. No, we have other instruments, futures and swaps. From those market rates, which are swap rates, right, future rates, we figure out the zero rate. That is called as yield curve construction. Okay, which brings me to the second Excel sheet, swap curve builder. Okay, how did we construct the risk curve basically? Well, the standard process is, you start with, remember we talked about calibration. So our anchor or starting point is liquid instruments. We look at the deposit, 1 day deposit, right? Just 1 day deposit. We also look at a set of 3-month futures. You can also have 1-month futures. So these are SOFR futures, which are quoted in CME, Chicago Mercantile Exchange. And these are the price. There is a concept of convexity adjustment. Right now, let's not discuss this. We'll do it in the course. And these are the rates that are implied by the future prices. Okay, liquid set of futures. One deposit instrument, several futures, and then a whole bunch of interest rate swaps. Right? So these are liquid swaps. From these 3 type of instruments, we back out. Now that also is very involved, because today if you have to know how a SOFR future is valued. Okay, so that's important. If you're still doing LIBOR based valuation, then you're way behind, right? Industry has moved to RFR. You need to know how to value SOFR futures. So this calculation shows you sequentially you can start calculating the rates and the discount factors. Okay, starting with the first deposit instrument, then futures, then interest rate swap. We sequentially calculate the rates and the discount factor. That is called as bootstrapping. Okay, so for different days in future, and this is in terms of days starting from today, what are the discount factors? We can bootstrap. Okay, so what you get is this from liquid instruments. But then this story is incomplete, because I need discount factors for all possible days, all possible dates in future, not only these handful of whatever 12 or 13, whatever it is, right? So what do I do next? Interpolation. What does interpolation do? What I got from the market is this: a set of discrete rates or discount factors from liquid instruments that I chose, right? Deposit, futures, and swaps. But I need to have a continuum, because tomorrow I need to price any kind of instrument with any maturity. So for that, I need a continuous rate curve and a discount curve. So we do interpolation. Now there are many different ways to interpolate. Okay, Simple one is just maybe I'll show you this first. Linear interpolation. Just do a linear interpolation in the zero rate space. That is one approach. Another approach is transform the zero rate to, not zero rate, log DF, log discount factor. Linearly interpolate log discount factor and then transform it back to get the zero rate. Okay. As you can see, these two are not very different, but there are a lot of technical considerations why one method should be better than the other. Okay. So we will discuss all about that. Different interpolation techniques. What are the things that you need to consider? How do you do no arbitrage interpolation? And when you choose a type of interpolation, what are the consequences on hedging? Tomorrow, if see these quotes are changing every day, every minute, every second. On your dashboard, the quotes, this is the market rates, right? They are fluctuating every second. And your zero curve is being bootstrapped and being interpolated in real time, right? So, question is, what if tomorrow, let's say, this particular future price changed? Based on your bootstrapping and interpolation engine, will that impact only, let's say, this particular tenor, or the whole curve will change? How disruptive is the change from of a market code to your zero rate curve? That is based on how you define your interpolation and this bootstrap, this whole yield curve construction. You have to consider these things. Okay, is the hedging local? Is it a local hedging or global hedging? Right? What is the impact and no arbitrage interpolation? All these things you have to take care of. So we'll talk about all of these later. There is another way in which you can construct the curve. It's by optimization. Okay, so we've tried to fit a curve and optimize some kind of a loss function. Okay, again, not to overwhelm you with technical details, but we'll cover everything in detail later. Just to show you, there is a famous parametric method that exists, which is called Nelson-Siegel method. It uses these four parameters, and this is the shape of the curve, and you just do the best fitting that is possible, right, by minimizing the loss function. And it will give you these parameters, and then you are ready to price any security. The other method is cubic spline, right? So this is another type of interpolation. Not interpolation, this is actually curve fitting. And this is based on cubic spline. In cubic spline, you typically mention knots, and then based on the knots, you stitch multiple cubic polynomials together to come up with a smooth curve, right? So I'll just change the knots so that you can probably see changing in real time. Yeah, right. So cubic spline. This is not the end of exhaustive list. There are many other type of methods. Okay. All right. So that's yield curve construction. This also requires the holiday calendar to get the days and the discount factor correct. Right. Okay. So again, as you can see already, this is very involved, but I would strongly recommend do not simplify the landscape because this doesn't help. Right. Once you master it, you're done. You're set. And in real job life, you will be doing these kind of calculations. Okay. So that's interpolation. What is the next step? So we got the risks, sensitivities. We know how to price derivatives. I mean, interest rate swap at the moment. We know how to construct the yield curve. Okay. What's next? Next is once you got the sensitivities, you should be able to calculate capital charge. To calculate capital charge basically means that tomorrow, if the risk factors move in the worst case possible way, what is the impact on your portfolio? What is the PNL? Worst case change, right? So, little bit of description on that actually. So here is the thing. We got the sensitivities. We know how to calculate the price. We for now, yeah, our risk factor is a reduced set of risk factors as given by the regulator, for example. Now, if you are modeling the worst case move yourself, if the bank is modeling this by themselves, it is called internal model. If the worst case move is coming from the regulator has done all the time series analysis and everything, and they have recommended, hey, this is the worst case move of a particular risk factor. Then it is called a standardized model, standardized framework, right? So in FRTB, in any other regulatory treatment, whether it's Basel 3 FRTB, Basel 2.5, whatever it is, if you're doing this internally, it's internal model. If you're using regulators prescribed risk weights, which are nothing but the worst case moves of the underliers, then that's called as a standardized approach. All right. Sensitivities, regulators cannot give. That is obviously something you have to calculate because it is your instruments, right? So Greeks is definitely something you have to calculate, but this one depends. So if you look at FRTB capital charge, for example, this is a standardized approach that I have here. It's a, yeah, there are some additional considerations, but you start with the key rate sensitivities. That is the input to the entire aggregation engine, FRTB engine. If you look at standardized approach, I'm talking about standardized approach. The starting point is sensitivities. This is all you need to give to the engine. Everything else is given by the regulator. Okay, regulators have prescribed the correlation scenarios between the tenors, right? Under high, low, medium correlation regime, and they also have given the risk weight. Risk weight basically means how much the risk factor can move. Okay, that is coming from the regulator. And then you marry the sensitivities and the risk weight together through this correlation. Yeah, the whole bunch of calculation, and then you come up with the capital charge. Okay, this is how much you can lose, you know, with a given confidence interval. So for regulators, they are today we're using expected shortfall at 97.5%. So this one closely calibrates to that value. Okay. So that's the capital requirement, minimum capital requirement. I hope you're understanding the flow, right? Pricing, sensitivities, uh, then risk factor construction, because you need to know pricing to do that. After we got the risk factors, then we got the sensitivities, transfer those sensitivities into the regulatory risk capital calculation and get the risk capital. Last and final step. What do we have? Stress testing and limit monitoring. So now that we have these inputs, these sensitivities to the risk factors, right? We want to hedge that risk. Maybe this risk, some of the risks are not tolerable, or it is breaching the capital limit, or some of the limits that we have in terms of exposure, internal limits, right? So we want to control this risk by entering into hedging instruments. Hedging instruments could be, let's see, this is the hedge library. So in the hedge library, we have different types of SOFR futures available. How would you hedge the risk of interest rate? By entering into futures and swaps. That is what every bank does, right? So let's say in the market right now, we have these liquid instruments trading, highly liquid. So for 3-month, future 6-month, 1 year, 2 year, and then we have some swaps, some payer swaps, some receiver swaps. Using these as hedging instruments, we can come up with the portfolio composition and reduce the risk as we want, right? So let's see how we do that. We can potentially do a optimization. Okay, what this optimization does is you need to solve for the notionals that you need to invest in the hedging instruments. So this is what the solver gives us. This is the answer. These many notionals I need to enter into the under these hedging instruments. What am I optimizing? Well, after I enter into the in these hedging instruments in these notional quantities, What is my residual capital? This is after the fact. After I have entered into the hedging instruments, this is the current capital. This is the residual capital. See, it has reduced significantly because obviously I'll take offsetting positions so that overall risk is minimized. Uh, Again, I'm going at a very very high level, so some of this might be going over your head. Don't worry. The objective of this is not to explain the maths behind it. I'm just trying to show you all the important calculations that you need to be familiar with and what we'll be studying in detail in the course. Okay. So before hedging, after hedging, capital has reduced significantly. In the optimizer, what I'm trying to do is maximize capital reduction, ensuring that the residual sensitivities are within the limit. Now, talking about limit, typically banks will have these kind of limits set up. Okay. So for different risk factors, what is the limit? How much exposure can we take? How much exposure is there right now? This is the current, and this is after the hedging, and the usage is well within 100%. Sometimes if it goes to, let's say, 80%, we might want to update the indicator as, hey, this is a watch item because it is you're almost close to the limit, right? 80%. If it is well under the limit, then it's okay. So you have to take these also into considerations when you design the hedge portfolio. Um, yeah, I think that's pretty much right. So yeah, one more thing, stress testing. That's the last one. So from stress testing perspective, it is a combination of historical scenarios, hypothetical scenarios, reverse stress testing scenarios, and some any custom scenarios, right? So you have to. So again, this is a summary of different scenarios, but there is the how do you go about constructing these scenarios and these shocks? Okay, so we'll discuss all about that. There is quite a bit of literature behind this. So based on each of these scenario, right, parallel 100 plus, parallel minus, steepener, flattener, twist, and all these things, see that before the hedging, what was the exposure, like how much was the PNL before the hedge portfolio. You can see these blue ones, and after hedging the PNLs have reduced significantly, which is the orange one, right? And this is the stress capital loss limits for various scenarios, and I'm well within the limit. Okay. Right. So taking all of these into considerations, I'll optimize the hedge portfolio, ensure that my risk is reduced and I'm staying within the limits. If there are other business constraints that I can also put, but ultimately everything goes into a solver, and solver gives us the hedge portfolio. All right. So these are the four important pillars that you need to know about. There are a few more which I don't have it yet. The next important step would be, okay, what are the enhancements to this? Right now, we learned everything from the context of an IRS. In the course, we will be dealing with a lot of different types of instruments: forwards, futures, swaps, options under different asset classes. So you can imagine pricing template for each and every type of instrument. How do you calculate sensitivities in that pricing template? All those we'll learn. We will also learn how to do risk modeling using internal methods, right? So value at risk calculation, expected shortfall calculation using historical method, Monte Carlo, and parametric. There are a lot of different small considerations there when you are doing it practically, right? It's not a theoretical exercise. So that also will do, okay? Which is not something I could show right now. The third important thing, very important thing, is model validation. I will have a separate webinar just on model validation where it will be very interesting. Don't miss that. Where we'll talk about traditional techniques that we have used and how AI is shaping the model validation role, right? How can we can use agentic AI to automate some of the model validation tasks. So that is another important module. So we'll have a separate webinar on that. And there is a whole another risk dimension that we did not discuss. which is counterparty credit risk. Okay, that is also part of this connected story. Because when you enter into an interest rate swap, you cannot enter in a vacuum, right? There will be a counterparty. What if the counterparty defaults? That's like chapter 2.0 of the story, right? You talk about default risk, you talk about CVA risk. So all these things we have to learn, and there's a lot of modeling. But yeah. So again, my job is not to create a 200-hour course. Obviously, that doesn't help neither me nor you. We'll have a compact, precise 50 hours duration course covering all these important elements, which are uh, focused on the job requirements today. Okay, if you are signing up for an independent price verification or product control kind of role, what are the things that you need to know? If you are entering into a model validation role, what are the things you need to know? If you're, if you're hardcore front office guy, if your focus is master derivative pricing end to end, then there is another offering which is called quant finance. We can talk more about that. But from a pure market risk and counterparty credit risk perspective, risk model development, price verification, product control, stress testing, CCAR, DFAST kind of things, hedging, and yeah, these are the things that you should be targeting. Okay, 50-hour duration would be all the recorded lectures duration combined. Okay, and live sessions would be separate. Live sessions will do summary of the topic, will solve a lot of questions, and important interview questions we'll discuss. Okay, so that we have a live element, and you are getting prepped up for the actual interview. All right. So yeah, that's what I wanted to show you to give you a feeling of what kind of modeling or calculations that are involved in this particular market risk role, and what are the calculations we would be doing. So this is just to give you a sneak peek or kind of a preview of the things that we'll be studying in this particular course. And as I said, it's time to move away from pure academic exercises, because if you keep doing that, right, there'll be a huge gap for you to fulfill once you land in the job. So that's why I took Bloomberg as a benchmark, because there is nothing more authentic than Bloomberg today. And all our calculations are validated against the Bloomberg style calculations, so you can be confident that what you are doing is correct. Right? So yeah. All right, so that's the one. That's all I had from a demo perspective. I'll stop recording now. Again, I'll just flash the contact numbers if you want to reach out to us. Yeah, take a note of that. Let me stop recording. I can answer any other question you have. All right.